layman's terms, what is a hedge fund?
A hedge fund is a collected pool of money that is allowed to invest in instruments not usually accessible to a normal individual with a low net worth. So most retail traders will know about stocks and shares and maybe futures and certainly foreign exchange. You can then get slightly more complicated in terms of options, but then you can also go into sort of the interbank realm of swaps and swaptions, caps and floors, bond options, bonds themselves, things which you either need a lot of capital or you need specialized connections and techniques and equipment to be able to trade. So a hedge fund facilitates that. And again, they're slightly different in terms of that they're unregulated. So pension funds, which also manage people's money, have regulatory inhibitions or blocks in terms of being able to trade various instruments. So hedge funds are completely uncontrolled in that respect. They can do whatever they want to. And so ultimately, they are charged with taking people's money and trying to increase its wealth. So ultimately, yes, it boils down to trading. Anything that moves, if you can buy it, sell it, it's liquid enough, put on a position and see what happens. So that's the main distinguishing factor. Hedge funds are also interesting in that respect that the person who sets it up, from his perspective, it's a leverage game. He puts in a certain amount of money, but if he attracts much more, remember that he gets a fee on the performance of that much more. So the person who sets up a fund sets it up primarily to use other people's money to leverage his own returns. And again, that doesn't necessarily happen in big asset management houses who are, and certainly the way they structure their pay, it's more focused on accumulating assets for the people who invest in them.
So on that basis of it being unregulated, do you have the best traders when it comes to hedge funds?
So that's an interesting question, and I'll make it very specific. How do you quantify best? So the way I would quantify best is I take a trader at the start of his career and I'd actually map out his P&L throughout his entire career. So life to date, not just in a particular job or measured by the bonus he gets paid, but by his actual life to date P&L. And so the question therefore is how many traders, not just in hedge funds, but on prop desks, etc., how many have a positive life to date P&L? And I think what people need to understand is that the majority of them don't. And you have to ask yourself the question, why? So there's a difference between a trader and a hedge fund owner. So if you focus on the trader in the hedge fund, he has a job and he gets remunerated at the end of every year with a bonus. So to him, the job is like a lottery ticket because he still gets a salary, but if he hits it out of the ballpark, he gets a big chunk on top. So any human who plays a game optimizes the game. And in this particular case, the game to optimize is get that chunk at the end of the year. Now, it doesn't matter if it's in this job or that fund, it's about optimizing that bonus payment. So I certainly know lots of people whose life-to-date P&L is 0 or negative, but they do drive Ferraris and have big homes because they did have a period in their life when they just completely hit it out of the ballpark. Then they took that bonus and they stuck it into government bonds because they wouldn't trade their money as riskily as they would trade other people's money. Now, there are obviously, as in every population of people, a certain set, small group of people who are truly phenomenal. They're gifted and they're very talented. And going into the area of expertise that I have, systematic trading, there are certainly systematic funds out there that have performed tremendously well sticking to the rules. I mean, anybody can find them by Googling trend following funds and you'll come up with a standard list of names. You can even find their performance over the last 20, 30 years. You'll certainly see that they massively outperformed the S&P. And so that's actually really reassuring because it means that going back to that distinction between discretionary and systematic, it means that there are rules that you can learn, implement, and stick to and make money. And ultimately, that's, for me as the mathematician, in terms of modeling the world as a puzzle piece and looking at the patterns of relationships, that's very reassuring. It means I'm not an economist guy. I didn't study economics. I looked at patterns in nature, and the fact that you can find them again in markets and repeat them, that's fantastic. That's phenomenal.
What can a hedge fund manager, say somebody that's looking after 300 million, what could he expect to earn?
So a rule of thumb, I mean, I'm not sure if it's still the same kind of fees today, but you take the 300 million and you charge what's called an asset management. So for the privilege of having deposited money with a hedge fund manager, the hedge fund manager will charge 2% on an annualized basis. So on 300 million, 2%, that's what, $6 million. So that's just fees that he's getting in. Now, if he makes profits, then he will get a fifth of those profits, so 20%. So let's say that he makes 10% on the 300 million, so he makes 30 million, a fifth of that is 6 million. So he'll walk away with maybe $8 million. And then that'll have to be dispersed with his business partners, offices, etc., etc., etc. So the game, therefore, for a hedge fund manager tends to be the fixed fee, because that's guaranteed. And so, therefore, the game is to increase your assets under management to tremendous size. So if you look at funds that have $30 billion under management, 2% on that is $600 million in fees every year, regardless of performance. And you've certainly seen over the last 16, 20 years, as the hedge fund industry has grown, that's exactly what's happened. A lot of people have implemented very good marketing, also on the back of very good strategies, to increase their assets to phenomenal sizes that they know every year I clip a particular coupon. And that then takes the burden of having to make a performance out of it. And you certainly see hedge funds that over the last 3-4 years, where it's become very difficult, haven't actually made any profits, but they've still clipped big coupons.